Welcome to the Savvy Investor, where it's our job to help you thrive in any economy. You've been told over and over again to invest in the stock market. Certainly every brokerage firm and mutual fund company out there seems to encourage you to put your life savings at risk. Why? Isn't there a better way to invest in the stock market? Today on the Savvy Investor, we're going to explore patented technology designed to offer you protection against stock market volatility.
Welcome to the Savvy Investor. Each week, the Savvy Investor helps viewers just like you create and grow wealth, protect and preserve it, and distribute it in the most tax-efficient manner while alive and after you have passed. Our goal is to make you a better informed investor that hopefully leads to better results, but certainly less risk along the way. You can have financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your retirement forever. And now, the Savvy Investor with your host, Michael Canet.
Have you ever seen a TV commercial or an ad in a magazine from Fidelity or Ameriprise? How about when you're online doing some investment research? Have you seen those ads from Ken Fisher? Everywhere I turn, there's an ad by a mutual fund company, a brokerage firm, or some financial company telling me that I should trust them with my life savings. Does this sound familiar? Have you gone and sat down with one of these companies, called one on the phone? I suspect the conversation went something along the lines of, sure, we can help you retire. We can run some assumptions and some scenarios, and we can show you the best place to put your retirement nest egg. You ask some questions about fees and the experience of the advisor, but when you ask about what they do to protect your nest egg while it's in the stock market, well, I bet they say something that, there's no guarantee and the stock market goes up and down over time, but you're going to make money. Well, perhaps that's true, but do they have a plan in place specific to you to make sure you know when your account is going up, when you're at all-time highs, and more importantly, do they have an exit strategy to make sure that your retirement nest egg doesn't drop 40% like it did in 2008? What if there was a plan in place, a plan that would provide you that safety, but also allow you to invest in the stock market? No, I'm not talking about annuities here. While they do work and allow you to participate in the stock market with virtually no risk of losing your principal, that's another show. Today, we're specifically talking about a plan that provides the safety net while allows you to actively participate in the stock market. We're talking about stocks, bonds, mutual funds, and even ETFs. Now, before we go there, let's take a look at what's in the news. In our news today from Annuity Gator, we have a piece called Why Ken Fisher Hates Annuities and Thinks You Should Too. Annuity Gator really delves into the brochures Ken Fisher sends out, and the bottom line here is Ken Fisher's really concerned about the 3 to 5% you're paying in annuity fees each and every year. From Bankrate.com, we have a piece called My Life Insurance Company Went Broke, and here the conversation is about the fact that 8 insurance companies were insolvent in 2008 versus over 456 banks going under in 2008. And finally, our last piece comes from Forbes, and I thought this was a really interesting piece. Income as the outcome, reframing the 401k plan. What Forbes is talking about here is for the longest time, most people had a pension plan. The company provided you income, and you used your 401k just to kind of supplement your income through retirement. Well, today, that 401k is the main source of income. You have to use that 401k for your own personal pension plan. Today we're going to explore whether there's a better approach, a better mousetrap, if you will, than relying on Wall Street and those brokerage firms to look after your nest egg. You're watching The Savvy Investor, and we'll be right back.
Call for your free retirement guide at 1-800-787-SAVVY. Interested in learning more about planning for your financial future? Join Michael Canet, host of The Savvy Investor and best-selling author, in person for an important life-changing financial workshop on the following dates, and start taking control of your future. If you are ready to discover the financial tools and strategies that can help you build the retirement of your dreams, just call 1-800-787-SAVVY today to reserve your spot.
Want to lower your taxes by as much as 25% this year? If you think Uncle Sam is taking too much of your hard-earned money, it's time you did something about it. Our specialists and attorneys have over 100 years of experience helping hard-working retirees just like you. For a limited time, we're giving $99 income tax preparation appointments to everyone who calls and mentions this offer. Our licensed team of professionals can help assist you with sound tax planning, financial planning, and investment management. Taxes are too important to let just anyone prepare your returns.
Call ProStatus at 800-787-SAVVY or visit ProStatusFinancial.com to ensure you get all you've earned.
Welcome back to The Savvy Investor. Think about this for just a minute. You've worked 30 to 40 years accumulating a retirement nest egg. You see a commercial on TV or you go to a dinner seminar and you decide to go see that advisor. He spends a little time with you and then invests your money in the stock market. He tells you that you can take out a percentage every year, and then if you follow the tenets of buy and hold, you'll average 8% or so during your retirement. Well, I have a couple concerns here, and you should as well. First, isn't the premise of buy and hold exactly that? Buy and hold? How does buy and hold work when you're taking out money each month for your retirement income? The second concern here is what most financial planning does is it tells us that you can safely take out 2.8% of your nest egg each year. 2.8%. Really? On a $100,000 nest egg, that's less than $250 a month to use during retirement. And the biggest concern I have here is when, and I do mean when, not if, the stock market decides to correct. Well, if you only lose 10% like you did in 2000, that might not be too bad. But what happens when you lose 10% and then you lose 10% again and then you lose maybe 20%? Well, that's what happened between 2000 and 2002. And what happens if a few years later you lose almost 40%? It took you 40 years of hard work to accumulate this nest egg, and yet your advisor's telling you to take the risk of losing 20 years of hard work in a single year. Coming up, we're going to offer you a solution to this problem. Today we are joined by Jason Jenkins. He's a financial planner located in Colorado, and he's been named as the top 40 under 40, as well as the brightest leader of today and tomorrow, as well as being a contributor to Forbes magazine. But more importantly for today's conversation, Jason has created patented technology which will actually allow you and your advisor to set limits on how much risk you're willing to accept. Jason, welcome to The Savvy Investor. How are you doing today?
Great. Thanks for having me, Mike. It's great to be here.
So let's talk a little bit about investors' exposure to the stock market and the risk they're taking versus the risk they think they're taking.
I think it's often, and you know, meeting with your clients, where clients come in and they perceive that they've got limited risk, but often the portfolios have a lot more risk than they may realize, and it takes a market correction for them to find that out.
Well, when you say they have more risk than they realize, what does that mean?
I think what it means to an investor is something I call, we all have an emotional downside threshold. All of us don't want to lose more than 10 or 15%, and knowing what that looks like, but it's when an investor loses 20, we know what happens. They end up selling, right? And that's what creates that loss of wealth when the markets decide to bounce back. So knowing what that maximum downside exposure is that they're looking for is pretty critical, and that needs to connect with their portfolio.
I guess what I'm concerned about for clients, you know, when we get our emails and when I'm talking to guys like you from across the country, you know, I hear all the time about let's allocate, just have to have the right allocation, and it seems to me that people think that these allocations are what are going to reduce their risk, when in fact, you know, I understand the concept of modern portfolio theory, but I think twofold. One, people in general are taking on too much risk because they think the Federal Reserve is going to bail them out, you know, because everything's too big to fail now. But also because the advisor said, you know, if you put 20% here and 10% here and 10% here, you know, you diversify your portfolio and you're fine. But that hasn't been the case.
It hasn't been the case, and so there's obviously a lot of great history about asset allocation, modern portfolio theory. Really what it comes down to is correlation, right? I might have 10 different positions, but they could all be highly correlated.
Right.
So it's not so much about asset allocation, but it's about the importance of having the proper correlation inside of that.
And what
that's
does that
the
mean?
missing piece.
What's correlation mean?
I mean, correlation mean like this. So let's say I have Google in my portfolio, for example, and I've got another Facebook, right? Those are the two stock positions that I hold. Well, those are highly correlated, meaning they're in the tech sector, and they could
Similar industry,
so they could create great news one day, but it could fall down the next. But if I had Google and let's say Coke, right, a large cap value dividend-based stock, they begin to, even though they're a stock-based, they begin to uncorrelate, right? One's large cap, one more is going to be more growth-based. And so that's the example of what investors often miss. So we talk about asset allocation. I have 60%, you know, equities, 40% fixed income, but yet they fail to really understand how correlated is this portfolio. And the right advisor can help them understand that, and that's what's going on.
So do you think that people who feel like they're diversified, that they own Google and they own Coca-Cola, you know, if their advisor is telling them that they don't have it's a non-correlated portfolio, they're still at risk because in 2008, it didn't matter, right? I mean, it was just, everything was a free fall.
Yeah, for the most part, almost every asset class, for the most part, was absolutely down. And so, again, you have to find ways to protect yourself, even in those kind of outlier moments, like a 2008.
Right.
Because they do come. Markets go up and they do correct. And so you have to have a plan day one to address how am I going to handle that if a 2008 comes.
And I know when you came in today, you didn't bring your crystal ball with you, so I don't want to put you on the spot for what's going to happen. But you know, one of the things that we talk about on the show on a regular basis is that the market is in the middle of a huge bull run, and at some point, it has to correct. And it might not be this week or next month. Heck, it could be another couple of years before it corrects.
Yeah.
But it's going to correct, and when that happens, people are going to get hurt.
Yeah, again, not knowing when or to what degree, people are going to be overexposed. And that's really when they, because when that greed factor comes in.
Oh, yeah.
And we've kind of seen that, right? Like, oh my gosh, my neighbor's making money, so I've got to make money with it. And so they begin to overexpose what they're willing to stick with. Right. I often say a great investor answers two key questions. How much risk can I afford to take? But more importantly, how much am I willing to take?
Right.
And that's the key, is the willingness and understanding that I've got to create something that I can sustain to not only the upside, but more importantly, the downside.
And it's interesting, you kind of alluded to this, that people, they think they're willing to take this, but when the reality comes, we've seen report after report and statistic after statistic that the average equity fund does 8 to 10% over, 15, 20-year rolling periods.
Yeah.
But Ned Davis and Fidelity, all those companies come out and tell you that the actual investor,
Dalbar study,
the average investor does what, 3 to 4% at best.
That's correct.
And that's because they do exactly what you said they did. They say I can afford the risk and I'm going to be a long-term investor, but they turn around and sell whenever the market dives.
Yeah, it's very short-minded, right? They find themselves creating their own trap.
Right.
And so they end up buying high and selling low, and over a period of time, that destroys any kind of wealth potential. And so they feel like, oh, well, somebody else has got a better, solution. So they jump over to a new advisor or they jump over to a new product versus really asking fundamental questions. And so there lies this kind of self-entrapment that they've created.
So we've established, and I think it's clear that everybody understands that the market does go up and down.
Yeah.
And people do take too much risk, or at least they're taking more risk than they truly think they're taking.
Yes.
And so I know you have a solution, and we're going to take a break.
Okay.
But when we come back, we're going to talk about a solution that people can use in order to protect themselves from some of this market volatility.
Absolutely.
You're watching The Savvy Investor, and we'll be right back.
Call for your free retirement guide at 1-800-787-SAVVY. Interested in learning more about planning for your financial future? Join Michael Canet, host of The Savvy Investor and best-selling author, in person for an important life-changing financial workshop on the following dates, and start taking control of your future. If you are ready to discover the financial tools and strategies that can help you build the retirement of your dreams, just call 1-800-787-SAVVY today to reserve your spot.
Most of us understand that planning is the key to retiring with the resources and benefits you need. Most of us also don't think about what would happen if a significant portion of these resources were taken away from us before we reached our goals. This can happen through a bad investment, a lawsuit, or even unintended expenses.
As the nation's leading asset protection attorney, this is the area in which I work, to protect the assets you've worked so hard to create so that they're there for you when you need them.
Call 1-800-787-SAVVY.
Welcome back. Today we're talking about being able to rely on the stock market or your advisor during retirement. We all saw the market losses of 2008, and many of us saw the losses during 2000 to 2002. Our guest today, Jason Jenkins, has developed a patented approach to avoiding a market crisis. Now, before we address these questions, let's take a look at some of your email. Now, we have our first email from Allie in Chicago, Illinois, and she's saying that her advisor told her to use stop losses to protect her retirement accounts. How do you feel about that?
Well, I recently wrote a paper on this about kind of why stop losses don't work. In theory, in a normal market, they can, but the challenges of this is that they're technically not a guarantee for an investor. And there's many different cases about what can take place. Well, the challenge is they expire every 60 days. If you hit them, there's a transaction, so people need to be aware that there's a commission on those. And so I actually personally believe it creates an environment for a little bit more anxiety than the investor really feels that's actually taking place. A company could get bad news over after hours, and let's say the stock was at 20. Could that stock open up at $12 or $11? It absolutely could.
Right, and bounce you out on your stop loss.
And bounce you out on your stop losses. And then there's a whole secondary market that a lot of people don't realize is that there's some pretty savvy investors that can see these blocks of trades coming. And so when you think of the flash crash, I mean, how many people actually stopped out and they saw those thresholds, and then that smart money actually bought that market back up
at the downside.
Yes.
So let's explain though, because you know, Allie's asking about stop losses, and clearly her advisor has talked to her about what a stop loss is. So let's tell our viewers, let's explain what a stop loss actually is.
So stop loss is an order that, let's just use Coca-Cola for example. Like let's say if Coke was trading at $30, that we don't want to go down more than a certain percent or a dollar amount. I don't want to go below $27. And if I do, then that position is going to execute, and it's going to preserve, in theory, that I'm only going to go down that $3 per share.
And you can use stop losses on equities like stocks or exchange traded funds, but you can't use stop losses on mutual funds.
That is correct.
Right. So great question, Allie. Now our second question is from Jessica in Toluca, California, and she has read that Susie Orman's books. She's read Susie Orman's books, and says that Susie recommends using an index annuity. And does it make sense to put all our money into an annuity to avoid any market losses? Because I mean, we're talking about you know, avoiding these losses and still being in the stock market. And you know, I've read Susie's books, and she basically says if you want to participate in the market and avoid losses, use an index annuity.
Correct.
So what do you think about
I think the proper fixed index annuity is a great solution. But should we put all our assets in that particular situation? The answer is no.
Right.
Because you have to address risk in a multifaceted manner. A fixed index annuity addresses it with zero tolerance. You won't lose to market risk. It's great for income purposes. But there's other issues that would need to be taken into consideration, like liquidity. And do we have some assets you know, that maybe have a little bit more upside towards inflation? But I think fixed index annuities are great vehicles for clients that want to have a safe foundation and you know, really help provide some future security income-wise.
And I think also that Jess needs to recognize that with the fixed annuities, the fixed index annuities, there's limited upside. Many of them. I know there are some out there nowadays. We've seen some new ones come out over the last year or two that really allow you to have a little bit more flexibility, a little bit more of the upside. But contrary to what some people may hear on the radio, you know, double-digit returns are not necessarily the norm.
Yeah, and I think you know, your viewers understand that we shouldn't kind of, you know, the whole attitude, not have all our eggs in one basket.
Right.
You know,
absolutely.
You know, it applies to this as well.
Right.
Fixed index annuities done properly can be a great solution to a piece of that individual's portfolio.
Right.
It's really going to be driven by that one question: what can I afford to be doing, and what am I willing to do? Great solution for providing that kind of additional peace of mind, but it shouldn't be 100%.
Absolutely, and like you said, there's never an investment vehicle or approach that should take 100% of your assets.
I agree.
Should never be.
I agree.
All right, so you know, when we left for break, we were talking about the volatility in the market and the ups and downs and the amount of risk that investors were taking, especially retirees that have been working all these years. And the idea that you've worked 20, 30, 40 years to accumulate your nest egg, and your advisor allocates you, and in one bad year like 2008, you lose, you know, 20 years worth of work in one bad market.
Yeah.
So, you know, you and your partners have developed a patented approach to minimize. I don't want to say take it away completely, because of course, you know, you can never guarantee that you'll never have any risk, but to be able to participate in the stock market and really reduce that exposure to the downside. Let's talk a little bit about that.
Yeah, so we developed a technology called AssetLock, and we're helping clients across this nation. And really what investors care about when they go to hire a financial advisor is two numbers. What do I have and what's protected? And I referenced it earlier in your show. All of us have what I call as a downside emotional threshold. Maybe you don't want to lose more than 15, I don't want to lose more than 10. So wouldn't it make sense to identify that today, like day one, before I go invest in something that's uncertain? Because that's what the stock market is. Well, AssetLock helps you put those parameters. So if you don't want to lose more than 10% in your IRA account, wonderful. Well, let's set that in motion today to monitor that. And so what's great about AssetLock is that it looks at the aggregate of the portfolio. So at the end of the day, it says, what's the aggregate of that total sum? And so that's what reports back and allows clients to have the peace of mind that their financial advisor that's approved with it, we're truly watching it on a daily basis to make sure that we don't go below 5%, 10%, or whatever that is set by the client.
When we're talking about you have this 5%, 10%, whatever the number is, whatever your number is, the risk you're willing to take, the amount of loss you're willing to absorb, and you've talked about how much am I really willing to take. That sounds a lot like a stop loss.
It does, but the difference, there's big differences, is that the value of the stop loss, knowing that I don't want to go below a certain percentage, what it does is it begins to neutralize the biggest problem. And the biggest problem is emotions. So when I had a chance to develop AssetLock, it was a kitchen table idea, so I wrote down emotions. What if we could help clients stay emotionally strong? Because if that's really the central problem to this, remember clients buying high and selling low, that we could really help a lot of clients. But it's not a matter of trying to guess, oh, did Coke go up or do I adjust this stop loss? No, a client needs asset allocation. They need to be uncorrelated, but we want to look at the whole.
Right.
That's the key to this. When clients hire a financial advisor, they are paying a fee for them to worry about the daily activity that's going on inside of it. But when the client logs in or they do the review, they care about two numbers. What do I have and what's protected? AssetLock creates an environment for clients to be successful. And that's exactly what it does. Because imagine you're a client and you've been using our technology and you wake up one day and you realize your AssetLock value, the value that you can't go below, is greater than your deposit. I mean, how do you think that would, your viewers, how do you think that make them feel?
Right, and I think, obviously, that's a huge emotional relief because you know, no matter what happens, I'm not going to go below where I started, which is great because I think for most people, they still worry that you could go up and down at this point and lose part of my principal. And to be clear about the distinguishing the stop losses, I think your point about, you know, let's say you bought Coca-Cola at 30 and then overnight there was bad news and Coke dropped, you know, to 15. You know, if you had a stop loss on an individual position like that, it's that individual position that just dumped out. And we know Coca-Cola is going to bounce back. Even if it doesn't bounce back the next day, it's going to come back relatively soon on that type of news.
Correct.
But if it's in the total portfolio, because that's what you're doing, and obviously you can't put a stop loss on a total portfolio, which is where your technology comes into play.
Exactly, but that's what clients care about, right? And the beautiful thing about being an investor is, yes, I have to have diversification, and that's critical for long-term success. We joked about the crystal ball. Yeah, it's not there. So again, I shouldn't be trying to guess direction on an individual position because we know that is a losing game.
Right.
You're going to get whipsawed, you're going to end up buying high and selling low, getting frustrated, pulling out while others are making wealth.
Right.
The key to making wealth is, one, identify the proper asset allocation that's not correlated. Second, what am I willing? What's that downside? Because when I do step into the market, most investors understand that there is downside to that.
Right.
But I should know day one, what is that maximum amount that I'm willing to tolerate? And then therefore set the parameters around that. And the challenge has been our industry's kind of gone the other way. Hey, look at the portfolio, and yes, I have to be smart about it, but more importantly, we have to understand that we're all emotional creatures.
Right.
Right? And so
this takes it right off the table.
And it takes it right off the table.
Right.
And now all of a sudden, AssetLock, and it creates that environment. So
well, and I think an important point that you make there is that when you're meeting with an advisor, frequently the advisor is showing you returns and look how well this fund has done, and their focus is on if you buy and hold for the long haul, you'll make this type of returns. You know, obviously past performance is not an indication of future results, but they don't talk to you about that. They talk to you about look how well it's done, look how it's averaged over time. And your point, I think, is more valid that yes, we want to look at returns, and that's how we help pick the allocation to begin with, but we don't make our final decision on how well it's done in the past.
Correct.
We make our decision on how well it's doing right now, because if it's tanking, we're calling the advisor saying, I need to get out.
Yeah.
So if people want to do this, is this available to any advisor, or do you have and I know the answer to this, so I'm setting you up for this, but
all right.
you have a group of people that this is designed specifically for. You work with a specific group of advisors across the country.
Yeah, so the great thing about AssetLock is that we are looking for the highest quality advisors.
Fiduciaries, that's what you told me.
Exactly, that are across this great nation. So we have advisors right now that are across the nation that are approved by us, and people can find them at AssetLock.com. And they have to meet a very high criteria in order for us to say, yes, they can have access to AssetLock. We're looking for quality, not quantity.
Right.
We're really concerned about the investor sitting across that kitchen table or conference room table. Who are they talking to? What's their track record like? And things like that. So we're pretty picky about who we're working with.
And I like the idea that you've spelled out that the person has to have a fiduciary duty to look out for the best interest of the client, because that's the exception to the rule in this industry, which is unfortunate.
Yes.
We're going to take a break here, and when we return, we're going to do the 3 takeaways from today's conversation with Jason. You're watching The Savvy Investor, and we'll be right back.
If you have questions, drop us a line. Each week, our experts will address viewer mail, and you can email us your questions or go to our website, thesavvyinvestortv.com, and click on Contact Us.
Today we were joined by Jason Jenkins. He's the founder of Jenkins Wealth Management and creator of AssetLock. In today's conversation, Jason gave us 3 important takeaways. Number 1, work with a financial planner. A planner should create a sound retirement plan that addresses market volatility as well as income. Number 2, 20 years or 1 year. You've worked 20 plus years to accumulate your nest egg. Don't risk losing it all in 1 year. And number 3, it isn't how much you make, it's how much you keep. Have a strategy that can protect you from market volatility. AssetLock is one approach that may work for you. Thanks for joining us, and we'll see you, the Savvy Investor, next week.
Call for your free retirement guide at 1-800-787-SAVVY. Every retiree's goal, from our perspective, is to take the least amount of risk possible to accomplish your goals. Too often, financial advisors and stockbrokers assess your risk tolerance. Just because you can tolerate the risk doesn't mean you have to accept it. Remember, at the end of the day, it isn't how much you make, it is how much you keep. If you would like more information about today's topic, you can contact our offices or visit us on the web at thesavvyinvestortv.com. When you visit our website, sign up for our free weekly newsletter where we give you tidbits each week to help you make smart money choices.